Good afternoon, everyone, and welcome to our third and final webinar in our Explore and Exit webinar series. Today's webinar is covering selling to private equity. The first two covered selling to trade and selling to management or employee ownership trusts. Recordings of all three webinars will be available. Make a request to Gemma Lloyd-Jones. So really, today's webinar is going to be covering some of the aspects around selling to private equity, where as a firm, as a team, we have sold, we've undertaken transactions last year where almost half of the deals related to private equity. And I think that's quite a contrast over time, and there's an increasing prevalence of private equity in transactions across the region. Now, my name is Matt Wilmot. I'm a director in the corporate finance team at Francis Clark. I specialise in company sales, acquisitions, management buyouts, and employee ownership trusts. I'm going to be the host of today's webinar, supported by some corporate finance colleagues, Nick and Nathan. And we've also got a guest speaker today from the Business Growth Fund who shares perspective from an equity side. Now, throughout this series, we've aimed to give our attendees some highlights around some of the characteristics of the different types of options available to them when they're looking to realise value. Now, I want to emphasise the importance of planning and preparation for any type of transaction, and we really hope that by covering the full range here in our series, that all business owners can assess the extent to which those options meet their personal and business objectives, and ultimately help them with their preparation and planning so that they can make the most of their transaction, whatever it may be. So let's move on to introductions. So if we could go around to give a brief introduction, starting with Nick.
Good afternoon, everybody. Thanks for joining. My name's Nick Tippett. I'm a corporate finance director here at PKF Francis Clark. My role involves advising on a wide range of transactions and strategic advice, but relevant today is that a lot of the work that I'm involved in involves sort of selling to private equity, but also acting for private equity investors, so acting on the sort of their transactions when they're looking to make investments or when they're looking to exit portfolio companies. So bringing a sort of rounded perspective of different aspects of the transaction process from private equity.
Thanks, Nick. And Edwin.
Hi, yeah, I'm Edwin Davis, an investor at BGF covering the Southwest and South Wales. BGF is a minority equity investor, typically investing between £2 and £20 million for up to 40% in scaling businesses. I've been here for 12 years now and invested over 150 million in over 25 companies across lots of different sectors. So we invest across all sectors and seen many of those businesses through to successful exits. And today I'll be bringing the perspective from an investor's point of view, covering what we're looking for and what it's like to work with PE.
Thanks, Edwin. And Nathan.
Yeah, thanks, Edwin. Hi, everyone. I'm Nathan Hollands, Associate Director in the Corporate Finance team here at PKF Francis Clark. I've worked with sort of both sides of the table, so often supporting PE investors to sort of understand their investment, but also help management teams prepare for transactions. So hopefully trying to bring a bit of both sides of the perspective today.
Thanks, Nathan. Right, so let's kick off with our questions. Before that, just if any of the attendees wish to ask questions as we go along, please feel free to drop your questions in the box. We'll look to cover those as we go or at the end if we've got time. So starting with the basics, really. Now, private equity is a very broad term. So I guess, Nick, just what do we mean by private equity? What is private equity and what are the different types?
Sure, thanks, Matt. So at its simplest term, private equity sort of captures any transaction where an investor puts some money into a business and takes an equity stakeholding. So that is a holding of the sort of the share capital in the business. Private equity therefore captures everything from your sort of friends and family, if you're an early stage business, right through to your sort of angel investors, and then that sort of next stage, and then your sort of venture capital funders, through to sort of mid-market private equity market. So there's a really huge broad range in terms of the types of investors that are around that's captured by private equity. I think it's important just to sort of recognise that the type of investor that you're sort of looking to work with will depend on the sort of size you are as a business, where you are in your growth profile, what you're looking to achieve. Perhaps geographically, there's some different funds that operate in certain geographies. So there's a real sort of broad spectrum of different investors that will help people. And today we're sort of focusing on that sort of mid-market space. So you're an established business, you're looking to raise some capital and sell some of your shares to a private equity investor for various different reasons, which we'll sort of come on to as part of the process.
Thanks, Nick. So I think, obviously private equity is a form of funding, and I suppose looking at the sort of the puzzle of funding, Edwin, where does private equity sit relative to others?
Well, it largely depends on what type of transaction the business is looking for. So, for example, if a business is seeking funding for growth, there's various different sources of finance out there, as Nick touched on. Often businesses will go to the bank and try and raise some funding from the bank as a first port of call, because with that it's cheaper, you don't have to give up equity. But often there's then a funding gap, so the bank might be willing to lend a certain amount of money, but due to the risk profile, it might not be able to provide the funding that the business needs. So that's where an equity investor can come in and plug the gap to help support that growth. Or it might be a different kind of transaction where shareholders are looking to de-risk a bit. And again, private equity funding can plug that gap or fund the whole amount, depending on what can be achieved with bank funding. So it sits there nicely alongside other forms of finance. And
I guess, Nick, just leading on in terms of sort of what does it mean from a sort of selling to private equity in terms of the types of transaction?
So yeah, the sort of types of transaction can be really broad as well. So like Edwin's mentioned, it's sort of private equity is effectively a funding solution that fits within that sort of funding jigsaw for a business. So the types of transactions that they will support in is sort of growth capital, shareholder de-risking, so that shareholders taking some cash off the table in exchange for selling some of their shares. Some investors will sort of sell into, they'll take a majority stake in the business, and a lot of investors do that. So that you've got a more core wholesale of the business, and they'll support sort of management buyouts, and that sort of transaction. So there's a real range, and the sort of funding solutions that fit within that vary depending on what you're trying to achieve.
And I think probably just adding to that, a lot of the sale transactions that we get involved with the team will often be to what we maybe define as a trade buyer, but they could be equity backed. Perhaps they're doing a sort of buy and build, and that has different characteristics than perhaps a corporate that isn't, that's privately owned, for example. So in terms of when you might think about private equity, when is it suitable, and perhaps when is it not suitable? I guess from your perspective, Edwin.
Part of it comes down to risk profile, as I touched on. So whereas debt providers are more focused on cash flows and ability to pay the interest and repay the debt, the equity funding requires a strong growth opportunity. So particularly helpful where shareholders might have differing priorities. So some might want to exit the business whilst others might want to grow, and that they might have various options. They could sell the business, but if you've got those differing priorities, a PE transaction can help support with that. So provide the funding to buy out one of the shareholders whilst providing funding into the business to then drive the growth. So we see a lot of transactions where PE funding is used for exactly that sort of reason, whether it's exiting early investors, angel investors, or the founders of the business. And it could be a full exit or a partial exit for people. PE is particularly relevant for that. Or perhaps where management teams are looking for broader support for the business, which can be really valuable, and you don't often get that additional support if you're just raising funding from a bank. And we can come on to sort of some of those areas of support later in the conversation.
So I think what I'm hearing is there's a lot of flexibility. It can meet a lot of situations, particularly with sort of different shareholder dynamics. But a key underlying theme needs to be growth, because ultimately the PE investor needs to get a return, and that tends to come through obviously growing the business. Okay, so let's move on to how we find the right equity partner. Which out of all the plethora of funders out there, there are some other than BGF, but obviously that's an important one for today's conversation. what do private equity investors look for in a business? So Nathan, sort of going back to the sort of fundamentals, you know, how does someone make sure that they are attractive to private equity?
Yeah, sure. Thanks, Matt. I mean, I think firstly, it's not a one size fits all with private equity. I saw a statistic. I think there's over 1,000 private equity firms in the UK. Obviously, we have one with us today, but there's lots of different approaches, and whether that's at one end of the market, you might have seen the sale of Body Shop to private equity, right down to your sort of angel investors startup sort of phase of the business. Also, you're going to have sector niches, so lots of different focuses for different areas. I think today we're sort of focused on the mid-market sort of area, and there will be common themes. I think first and foremost, as you just touched on, Matt, that growth opportunity is absolutely vital. We're looking to make a return. So how scalable is the business? What's the future potential? Moving on from that, sort of stability of cash flows, really important area for private equity. So things like predictable recurring revenue streams where you can kind of see things coming out through contracts and that sort of stuff is really helpful. And that certainty in cash flows leads to higher valuations for private equity. Really important to note. I think a bit more detail in terms of the growth opportunities, value creation. Your investors going to really want to understand how they can add value to the business. So there's different strategies for that. It's a very common one, buy and build. So this is where the investor is looking to sort of acquire complementary businesses or competitors for synergies and ultimately grow the business through more follow-on acquisitions. But it can also include new product lines, geographic expansion, operational efficiencies, lots of different ways where you can add value, and that's really important. I guess I've touched on there a lot of financial aspects, but the deal is a lot more than just financial. There's a lot more sort of commercial areas to think about. So I don't know, Edwin, do you want to touch on some of the areas outside of that BGF would look for?
Yeah, sure. Thanks, Nathan. And yeah, as Nathan said, different PE firms will focus on different things, and you've got venture capital at one end of the scale, large cap PE at the other end of the scale. In terms of what BGF looks for, which will be relevant for most of those PE houses as well, key things are management team. It's who are we backing? Who are the key people in the business? What's their track record? And it doesn't have to be a perfect team, but it just has to be a backable team. And we and other PE investors can help build out that team. So if there are some gaps, that's absolutely fine. But there needs to be at least one or two key people in that team who are very backable. We need an established business. So we're not at the VC end of the scale where you're just putting money in based on a business plan or an idea. It has to be an established business with a bit of a track record and a strong opportunity for growth. The market it operates in is important. So understanding whether that market is in growth or decline, how resilient is the market, what's the size of the addressable market, and is the business a disruptor? So are they doing something really different to their competitors? And that sort of feeds into that growth plan. How will that growth be achieved? And that's really important for a PE investor. So as we touched on earlier, as a bank is more focused on cash flows, ability to repay interest, ability to repay the debt. A PE investor wants to understand where's that growth going to come from that's going to drive that equity value. And then another key thing is exit alignment. So it's going into something knowing that the other shareholders do want to achieve an exit at some point in the future. So understanding their aspirations and ambitions, what are they looking to achieve, and how can we help them to achieve that?
Thanks, Edwin. I think just touching on one of those points, so particularly management and the importance of management. Now, I expect there'll be a number of business owners listening to this, and perhaps they are sort of planning a full or partial exit. But how does BGF sort of, I guess, manage the dynamics of an exiting shareholder if they do or do not want to be involved in the business ongoing?
The key thing, I guess, from a management team's point of view or a founder's point of view, is making sure you prepare over time. So if you want to go into a PE transaction and exit in full, you need to think about that well in advance and bring that management team through. Because from an investor's point of view, if a founder wants to exit the business, we want to understand that the team in the business is actually running the business. We don't want to be in a situation where suddenly we're investing and the key person is taking all their money and leaving. So it's about bringing that management team through in advance. So some founders do want that full exit, but others just want to take a bit off the table now, de-risk a little bit, and stay involved for that future journey. But often we see their roles changing over time, so they might be sort of key in the business day to day, up to investment and at the point of investment, but they might want to phase that back and just work a few days a week over time, and eventually by the ultimate exit being more of a non-exec type position. So we can support with that transition. But yeah, the most difficult is where someone wants to exit in full day one and they haven't taken the appropriate steps in advance.
Which I think is a common issue through any type of exit event, but clearly there's ways and means to facilitate partial exits and bringing in management, as you suggested, which does help with that. Okay, so if a management team or a business owner is decided to go down the private equity route, Nick, what should they look for in a private equity? How should they explore the market?
Exactly. Yeah, so I will come back and answer that question. There's just one thing that Edwin sort of mentioned that I just wanted to pick up on, and that sort of exit piece. So what's really important and often missed by businesses is that actually when you're looking at taking on private equity have always got one eye on their exit. And so quite a lot of work gets done up front about thinking, well, who's going to buy this business in 3 to 5 years' time to sort of see that sort of journey, that investment journey through. And that's a bit that people often sort of, it passes them by, but that is a really important part of the sort of strategic thinking around taking on investment. Sorry, just to sort of cut back to that. But yeah, sort of in answer to your question, Matt, about what should people look for when they're looking to take on a private equity investment, I think it's important to recognise it's a really big decision. So you're going into effectively a partnership with somebody. You're going to own shares in a business and sit alongside that organisation. So first and foremost, the people that you meet in that process, and the people are the people that you will be working with. So you need to be comfortable that you could kind of sit across a board table and work with those people, because you are sort of going into that shareholder partnership with common goals. So that's a sort of really key metric. Then the sort of next piece is actually, have they got a track record of delivering good outcomes? So thinking about the sort of business you are, the type of transaction you're trying to complete, is that investor going to be one that can actually support you and get you into the right places? And a sort of good way to test that is their sort of credentials and track record. So looking beyond the sort of the cash that they're bringing to the deal, and actually thinking about, what does that business, what does the equity provider have in terms of strategic commercial advice to help you through your sort of transaction journey and your process post-investment. I think cultural alignment between the businesses is really important. For some businesses, a private equity wouldn't sort of necessarily fit within the cultural boundaries of how the business operates. So, and that will filter down through to how you interact with your staff, what the business is looking, ESG is a really important part for investors. So just making sure you've got that sort of cultural alignment on that side. And then, like I say, really the sort of the value, the money is one thing, but actually what's coming alongside that money, Edwin alluded to earlier, it's a lot more expensive typically than debt, but don't necessarily be put off by the cost, because if you've got the right equity partner alongside you, they will help you grow that business exponentially. And so, yes, there is a cost to it, but actually your reward can be greater if you're sharing that. So just understanding really what they're bringing to the party in terms of a sort of the future of the business.
Thanks, Nick. I think just touching on the sort of cultural alignment piece, I think this is possibly one for Edwin. So, there's, I think, possibly a dated reputation that private equity has, and I think that puts a lot of people off because of their perception of what it entails. I guess just in terms of why those perceptions are not necessarily reality, do you mind covering just a bit around that?
Yeah, it's a really interesting point, and really important in terms of choosing an investor, because the industry as a whole has got a bit of a bad reputation sometimes, and there are some horror stories out there, and therefore choosing the right PE investor is really important. And it's about understanding who you're going to be working with throughout the deal. Are they the people that are going to be on the board with you and working with you towards that exit? And it's about understanding how do those PE funds act when things are going bad, because because everyone that's had a great growth story and a successful exit will say good things about the PE house they worked with. But it's really interesting speaking to the businesses that have taken PE investment where things haven't quite gone to plan, and understanding, okay, in those scenarios, how does the PE house act? Are they there to support management teams through that journey, or is the first thing they do to fire the existing team and bring in a new team? And that's at the very, very extreme end of the scale. So there might be some out there that do that. It's probably less common these days, but it's that culture, understanding how they work with businesses, referencing them, speaking to other businesses that have taken investment from them is just massively important.
Thanks, Edwin. Right, we've had a couple of questions really around management. So I think the first one is looking at I guess the plans of the management team, and perhaps when they may be looking to retire or when they may be looking to exit the business. I guess presumably, I guess it's to Edwin as well, when you're looking at the management team, you're looking at their overall ambitions and trying to understand them when you're making a decision as to whether to back them.
Yeah, exactly. That's really important. And for us, it's just important to know upfront what are people looking to achieve. So we'll often have situations where some members of the management team might not want to be in it for another 5 or more years, and they might have a clear path to actually, keen to do it for a couple of years, but want to phase back over time. So if you know about that upfront in advance, you can start planning around that, start succession planning, think about where the gaps are in the team and how to build those gaps over time. So it's just important to know up front. If suddenly you do the deal and then one of the key members of the team says, "Oh, I'm going to leave in 6 months," that's then a lot more challenging. So it comes back to preparation, and I think that'll be a word that's used quite a lot in today's conversation. Preparation is just really important.
Yeah. Okay. Thanks, Edwin. And we've had another question around, I suppose it's sort of how management are incentivized, really. It's been described as sweet equity. Do you want to cover that one as well, Edwin, in terms of, how might you build a management team? Clearly, it's going to depend on the type of structure transaction, but just covering that side.
Yeah, again, another really important thing from an investor's point of view is that the people we're backing are properly incentivized to grow the business, because we're a minority investor. We don't get involved in the day-to-day running of the business. Our involvement is more at board level. So we're really trusting that management team to be on our side and want to create the most value. And the best way to achieve that is through them sharing in the equity. So often it's, the term often used is sweet equity. So where management team are getting that equity, getting that upside without having to pay full value for it, and therefore they're incentivized when it comes to exit that they are shareholders and they share in that growth that they've helped to achieve. Some people already have that equity. Often, if we're bringing in new members of the team, if we need to boost that management team, we'll use growth shares and things like that. But it's important that the key people driving equity value are going to be sharing in that equity value at the end of the day.
Absolutely. I think it's probably worth just adding to that, part of this sort of, I guess, engineering around the shares is very critical, and getting the tax structuring absolutely right is fundamental to that. So this all goes part and parcel. No two deals are the same. So it does take a bit of thought to make sure there's no issues that arise from that. Okay, so let's just move on to sort of exploring the process itself a little bit more. So Nathan, could you talk about, from an advisor, a business perspective, how does a business prepare for taking private equity?
Yeah, sure. Thanks, Matt. I mean, it goes without saying, preparation is really key to ensuring a successful outcome. As part of the process, it's probably going to be the highest level of scrutiny that your business has come under. There's going to be lots of questions and to be expected, really. Significant capital investment. Your investor's going to really want to understand what they're buying into. So I think the first element of that is sort of financial readiness. Clean, accurate sort of monthly financial information is really, really important, and that's something you can start preparing well in advance of a transaction. Going forwards, another important document as part of the process will be your financial model. So, this is often sort of one step further than budgets that you might already have in place. And, it's an integrated financial model that kind of shows your trading with assumptions of how you're going to grow and ultimately the cash flows that the investor can expect. I think sort of, next step on from that and following on is sort of being able to clearly demonstrate how your business has grown. So, common questions that we get asked are, okay, the business has grown. What's driving that? Is it more customers? Is it higher prices? What's the profitability looking like in different parts of the business? Yeah, I think it's worth sort of saying often we come across challenges where that information isn't currently in the business, and we've got a track record of helping businesses to prepare that information. So transaction recently where we were trying to sort of disaggregate between what customers are making more profit, what products are what prices have increased in products, and understanding that level of detail is something that businesses going through this transaction for the first time might not have already done, but we're here and able to help with those questions. That's important not just for looking back, but also looking forwards and being able to understand where the areas that the business can grow are. I think the other area is sort of really understanding what your key value drivers are. Having a clear message of what makes your business attractive to the investors. Is it your strong customer base? Recurring revenues. What is it that we're buying into, and making sure you sell that. On the flip side, be upfront about your risks. No business is risk-free, and having a strong understanding of that and being able to communicate that is a really strong selling point. I guess with all of that, there's a lot to prepare, and there'll be a lot of questions. I've touched on some financial elements. There's going to be legal, there's going to be tax, there's going to be sort of lots of different areas to consider. But it's easy for me to say, don't take your eye off the ball when you're going through the process. You're going to be speaking to lots of different people and being pulled in lots of different directions. But ultimately, you still have a business to run throughout all of this, and not hitting your budget when you're in the middle of a process is a really challenging sort of flag to get through. And actually hitting the budget on the other side demonstrates to your investor that you are an investable business and you can back your plan. I guess that's from my perspective. I don't know if you've got any tips from the trade, Edwin, of how to best prepare for a process.
All of those points you've touched on are massively important, and particularly that point around sort of taking your eye off the ball. We often see that where businesses are so consumed in an investment process that the management team aren't putting the appropriate time into the business, and inevitably trading sort of drops off a bit. And then if they're starting to miss the numbers that they've put forward, that just creates a lot of challenges for the PE house. So I think the key thing is getting the right support from advisors to support with that process, because there is a lot of work to do. If you've not been there and done it before, it's all very new. That there's just a lot to take in. So having the right people around you to advise you, to support with pulling together a model, pulling together the information, to give you support and advice on investment terms from the PE house, because there'll be lots of unusual things in there that you might not have come across before. So having an advisor that understands the market and can say, actually, that term, although it sounds unusual, is fair and reasonable. Whereas that term over that, no, that's off market. You shouldn't accept that. So having someone that knows what they're talking about around you is really important. Makes it much easier from our point of view as well, when there's an advisor pulling things together and supporting that process. And then I think getting started early is really important as well. So the process can take a long time. So you don't want to kick off something at the very last minute and expect to be done within a couple of months. It's just never going to happen. So start thinking about it early, prepare early, and it can really help to start having some early conversations with whether it's PE houses or potential buyers of the business in the future, and start building that relationship over time. So as I mentioned earlier, a key part of our buying decision is management team. It's about relationships and people. And often, if you're thrown into a process at the last minute, it's really hard to build that good relationship with the management team if they're meeting 20 other investors and you've got very limited time with them. So sometimes it's quite helpful to actually go through a process of thinking who might the relevant investors be, rather than going out to 20 or 30. Go out and speak to 5, 6, a limited number, and just try and build a bit of a better relationship without spreading yourself too thin.
Yeah, thanks, Andrew. I think there's a couple of points there. I mean, again, it goes back to preparation and planning. Now, clearly, it's an involved process, and the risk of taking your eye off the ball later in the process could be quite detrimental. So the more preparation, the more planning you can do before you enter that, essentially the less you'll have to do later when you are running a business and also trying to undertake a transaction. I guess just in terms of question for Nick here, in looking at the broader process and perhaps what might be expected in terms of timings, perhaps looking at the different key phases of a normal, if such a thing exists, private equity process.
Okay, Matt. So yeah, I guess the first point that you sort of raised there is there's no two processes that are the same. And so, yeah, any timetable is going to be really specific to your own business, and it's going to depend on what the use of funds are, where the business is on its journey, and all those sorts of things. You will, encounter in a funding process investors that can say they can close a deal out within sort of 6 to 8 weeks, and the reality is that if you've invested 6 to 9 months in advance and you've got all of your information lined up, you've got your data ready, you can answer every question through the process, you've done vendor due diligence, you're sort of fully prepared, then yes, you can have a process where you sign sort of heads of terms, and it's effectively a legal process through to completion. I think there is a lot of time in advance of that. I suppose from a sort of process perspective in each of the separate stages, when you really start, it starts about, you might start this sort of 1 to 2 years out from when you're thinking about raising funds, because you're looking at what is our journey, where do we want to get to, and then how are we going to need funding to support in that. And then if you've got that sort of plan and you're moving along it, you can start to prepare your information. You can engage with your advisors early, help them. They'll help you get the business set up. Your legal advisors can, help you align your legal contracts to make sure nothing comes out of that. So all you want all the way through, you're sort of aiming for, when you're sort of going from heads of terms to completion, you're going for as smooth a process as possible, because otherwise you sort of get delays in the transaction, challenges in the deal process, and none of that is congruent to the positive relationship. So that's why we sort of always talk about preparation. But then once you get probably 9 months, 12 to 9 months from thinking that you need some funding, that's really when it starts to sort of double down on sort of documenting the business. And this is the areas that we really support with, is documenting the business, refining who your investors are and who you're going to want to speak to through that process, building a business plan that's a sort of, a detailed document to provide insight into the business. And you've got to remember that these guys haven't necessarily done your deal in the past, so that you need to give them a lot of information to get them up to speed with what your sort of business looks like and how it operates. So you're sort of going through various different stages and sort of building up. And then you get to a point when you've got your data, you do vendor due diligence. So you go to a financial due diligence provider, they do the review, because that then gives you a report that you can show to a number of investors. And then when you sign heads, your sort of post heads of terms chances of completion are much higher on the terms that are being presented. So there is a sort of a long phase to go through, but it starts probably a couple of years out and it builds up in terms of involvement over time. I know that one of the questions that came in is actually, should senior management be fully dedicated to the process? It's important for senior management to be engaged in the process, but if you've got a sort of a board of directors, it's probably right to have certain people in that process that are more hands-on and involved than others. So always the transaction process will fall on a finance director and their team, because there's a lot of information that those guys need. But back to sort of Nathan's point about making sure you're continuing to keep the business, don't take your eye off the ball. If all of the senior management are focused on, we must get this deal done, it is likely that things in the commercial side will slip. So it's just about trying to strike that right balance and have the support around you to help you achieve.
I think I'd add to that, Nick, as well. We spoke a lot about having the right advisors as part of the process, but also, having the right people in your business involved in the process as well. We often see where, one person in the finance team is trying to take everything, or, it's the CEO is running the whole process. But, actually leverage the skills within your business and make sure you've got the right team around you internally to support you through the process, because, there is a lot of things to do. Just add to that one there.
Yeah, sorry, Matt. sorry, I'm going to just talk over again. Sorry, Matt, because actually that's a really good point, Nathan. And then the other bit is always having your eye on the market. So there might be a perfect time for you to raise some investment, and that might be in 18 months' time. But when you get 15 months out, all of a sudden the market's in a place where actually you're a really good asset and you can drive a really good value. So being aware of what's going in the market as well as what's going on in your business is obviously important as well.
Thanks both. Okay, I think once the deal's done, we've talked about the process quite extensively. The important thing is, what does it look like on the other side? What's it like being private equity owned or invested? And I don't know if you could, highlight some of the areas that will change as a result of the transaction.
Yeah, sure. And partly it depends on the type of investor you bring on board, whether it's minority or majority. So from a minority investor's point of view, we let the management team get on and run the business day to day as they would have done previously. So don't want to get involved or interfere in that sort of day to day running of the business or decision making. Where we see our involvement is at board level. So we'll take a board seat, and it's that involvement in the direction of the business, where it's going, strategic advice, acting as a sounding board for the management team, providing constructive challenge, but not telling them what to do or how to do it. And that kind of approach differs with minority versus majority investors. If a PE investor is buying the majority of the business, they might act a bit more like they own the business. It's their business, you're working for them. Whereas with a minority investor, it's your business, you're still majority shareholders. We're there to support you as much as you want, but not step on your toes. So we sort of bring that perspective, having invested in lots of businesses, going through the same journey, scaling from 5 million to 10 million revenue, 10 to 20, 20 to 30, and so on. And they all go through the same kind of challenges, whether it's around staff recruitment and retention, systems and processes, cash flow management, all of these sort of common problems, whether it's a manufacturing business or a tech business, there's similar challenges. So we can bring that perspective to the board table and be there to sort of try and help you solve some of those challenges. So if you've got a particular problem, chances are we've seen that problem several times across the portfolio. So either we can help you directly answer that, or we can introduce you to another company that's been through that same kind of challenge. And then there's other areas of support. So in-house support on ESG and technology and things like that. So if you're going through if you want to install a new ERP system, we've got people internally that can support with that. We've got loads of businesses that have been through that kind of journey. Got an in-house ESG person. Then it's introductions to wider networks, so non-exec candidates, and that's something we haven't really touched on so far today. But often when we invest in a business, we look to find an independent non-executive director to come and join the board of the company, as well as someone from BGF. And this independent non-exec would be someone that's been there and done it before. So whether it's from the same industry as you, and they can open doors and be that connector, or just someone that's got experience of sitting in your shoes and going through that growth journey. Because often we find it's a lonely place being a founder, CEO of a business. Who do you turn to when you've got a problem or a challenge? So having someone on your board that's been sat in your shoes, been there and done it before, that you can reach out to is really important. So we can help introduce those kind of people to the business. Then there's introductions to our wider portfolio. So we've invested in over 500 businesses across all sorts of different sectors. So there's lots of cross-selling opportunities there. We've got lots of examples where we've helped deliver significant revenues to businesses by introducing them to other portfolio companies. Then there's support with sourcing and assessing acquisitions if you want to go down that route. Support with banking conversations and sort of the best way to fund your business on an ongoing basis. Succession planning. So that's always really important, as we touched on earlier. If key members of the team want to sort of phase out their time involvement, or if there are some gaps in the team, helping develop that wider senior team and understanding sort of what that needs to look like when it comes towards exit. And then on exit planning. It's on the agenda from day one for a PE investor. So it's about trying over that journey, whether it's a 2-year plan or a 5-year plan or a 10-year plan, it's trying to position the business in the best way possible over that period so that it is ready for exit. Because often that exit can come sooner than people expect. You might go into a PE investment with a sort of 5-year time horizon, but after a couple of years, you might get an approach out of the blue. So just being ready for that, if it does come in, is really important. And that's an area that investors can help with.
Thanks, Edward. That's very comprehensive. I think that the key is there's a huge breadth of experience there. It's not just the money; it's a real support the future of the business and the management team. So that's really helpful. I guess we all hope things go well, and hopefully the business grows. It's sold. You touched earlier upon when things go wrong, Edwin. I guess one of the concerns that people may have is what happens if things go wrong. What are the scenarios, and how does private equity manage those situations?
Yeah, there's different extremes there depending on the investor, and sort of at the very extreme end of the scale, a majority PE investor that's more aggressive than others might just immediately want to change the management team and bring their own people in. That's probably quite rare. At the other end of the scale, sort of a more supportive investor, it's all about thinking how can we get through this challenge together. So it's working together with the management team, understanding what the challenge is and how to approach it. And the worst thing for an investor is surprises. So we don't want to turn up to a board meeting and suddenly find out there's a big issue or risk that management have known about for months. So it's sort of bringing the investor along on the journey, the good things and the bad things, making them well aware, so that suddenly it's not a case of, oh, we're going to run out of cash next month. That's a really bad place to be. So, but if the PE investor feels like they're on the same side of the table as you're working together, they will do what they can to get through that challenge. And whether it's providing some more funding to plug a short-term cash hole, or whether it's other ways of support, there are ways of sort of working with the team and getting through that. But it really depends on sort of the type of investor you work with, which is why it's really important to understand that cultural fit and understand sort of how they work and reference them before you get involved.
I mean, it feels like it's trying to be supportive to overcome the issues rather than being almost reactive and making change immediately.
Exactly, because at the end of the day, it's in everyone's interest to grow the value of the business. So as long as you're all pointing towards the same goal, the investor will do whatever they can to support you to get there.
Yeah, I think it's probably worth mentioning the importance of there will be various documents, whether it's an investment agreement or shareholders agreement, that will underpin the interaction with the private equity investor around how the decisions are made, things around performance, good levers and bad levers, obviously talked about quite extensively in terms of how management who are shareholders operate, and if things do go wrong. So getting a good set of lawyers that are experienced to ensure that your position is protected to the extent it will be or it can be. Okay, just in terms, we've had a couple of questions here. Nick, I don't know if you could cover this one for me. So if someone was thinking about selling their business, they might be contemplating selling to trade. I suppose, why would they go for private equity over trade?
So I guess if you're thinking about exiting the business at some point in the future, private equity should probably always be on your radar. It might not be your preferred route where there are trade options around, but it should always be on the radar and not discounted before you sort of explored it. So for me, I think the difference is typically with a trade exit, you exit in full, and you realize your full value at that point of exit. Whereas with a private equity type transaction, whether that's a supported sort of MBO or whether it's a sort of majority or it's a de-risking, you get the opportunity to sort of share in the upside of the future. So it is a stepping back from the business as if you're a sort of majority shareholder with a team that can take the business forward, you have the opportunity to step back and realize a significant proportion of your investment, but actually you've sort of got that part of the journey still ahead of you in terms of the opportunity for some sort of economic upside. So you can sort of have a chance to make some more money if things go well and the business does well. And with an equity partner behind you and pushing for that to happen, there's a good chance that you'll sort of get that. So if you're thinking, I would like to sell the business, I'm not quite ready yet, then actually this is always to fully exit and retire. This is always a good sort of route for that. So I think that's probably one of the main reasons, is that opportunity for future upside. Also, there'll be scenarios where private equity may pay more than trade, if it fits within the sort of portfolio of their businesses, if there's a strategic rationale for that, if they can see something in your business perhaps that you're not aware of. So there is an opportunity to drive a premium value through that process, which is why not sort of discounting the equity is the right thing to do when you're sort of planning ahead for the future.
Thanks, Nick. And I guess just touching on valuation, Edwin, I guess how might you approach valuation when you're assessing a business?
Yeah, it depends on a range of different factors. So historical financial track record, growth rate, where the business can ultimately get to, what's the growth of the market. But our approach is sort of looking at similar transactions that have happened in the market. What do those businesses sell for? Look at listed comparables. What are they trading at? And just taking into account a number of different factors that sort of feeds into what the value of that business should be today. So it's definitely more of an art than a science. So it's and what you'll find is different investors looking at exactly the same business based on the same information will come up with a range of different valuations. So ultimately it's what's it worth to that particular investor or buyer, and that range of valuations can be really extreme and quite surprising sometimes.
Yeah, I mean, we mentioned it on our selling to trade, where competitive tension obviously helps with valuations, and I think that holds true here. But as Edwin's saying, there's each PE house is going to look at things potentially quite differently, and some will value it more than others, despite having exactly the same information.
And that's sorry, Nick. That goes back to sort of the point around getting the right advisors on board, because if you can have that conversation with your advisor, they can say, actually, I know that PE house probably won't be that interested, won't pay that much, but that one over there's some real strategic rationale for why they might be interested and might be able to pay a higher valuation. So with the right advice on board, you can, instead of having to go out to 50 investors to find the right one, you might be able to narrow that list down quite significantly and approach just the handful of parties that are much more likely to get you the best outcome.
And I was just going to add that Edwin mentioned it being an art and not a science. And I think one of the arts within a sort of private equity transaction is, we've talked about how that exit route is really important. If you can sell what that exit route looks like, then that gives the opportunity for the private equity investor, who generally speaking isn't investing, the whole capital in the deal isn't their own money. A lot of the sort of funds will put some of their own capital into it, but they have to then sell that to their sort of investment committee and their investors. So if you give them sort of a good story and a well backed up in terms of what the exit for this business looks like in the future, that can drive early value, which may not be the same in a strategic sort of trade sale scenario, where they're more looking at the sort of the synergies that they can create to drive value. Whereas here you can say, well, actually this business will grow in the next 3 to 5 years and be worth triple what you've gone in at now. So we want you to recognize some of that value at day one. And that's where there's a sort of opportunity around that.
Yeah, I think that's a key point. You sort of, clearly day one value is going to be important to most business owners, but ultimately finding that right party who you think can grow the business and work with you. Because ultimately, if you're holding and retaining some shares for that subsequent exit, that could be substantially more potentially. So you might sacrifice a bit of day one potentially to make sure that you've got the right party. So it's I guess what we're saying is not purely day one value. That's not the necessarily the whole driver. Okay. Now, Edwin, you've been very kind and talked very broadly about private equity, and I just wanted to give you the opportunity to tell us why BGF.
So yeah, lots of reasons why BGF is a great partner. As I touched on earlier, we've invested in lots and lots of businesses across lots of sectors. We've got broad sector experience in lots of different areas. Big network for businesses to cross-sell into if they're the right kind of business. We're a minority investor, so we don't control businesses. We can take a long-term approach, and sort of one of the key terms that comes up a lot in private equity transactions is drag rights. So that is the ability to force a sale of a business. Some PE investors have it, some don't. So we don't have that kind of right. So that exit is in the hands of the whole shareholder group, not just the investor, and that's really important. I think it's the flexibility of how we work with businesses, that exit time frame. We don't have to be in and out within the typical 3 to 4 years. We can take a much long-term approach if people want that. Then there's the access to follow-on funding. So we can invest typically between 2 and 20 million on day one, but over time there's no upper limit to the amount we can invest. So we can keep funding businesses as they keep on growing. We've got 40 million plus invested in some businesses through several different funding rounds. So it's lots of things, but it's the way we work with businesses, the way we can support them, and as we touched on earlier, it's not just about investing some money and saying see you in 5 years. It's about working together. How can we all create value together? What can we do to support you on that growth plan? How can we open doors? How can we introduce you to the right people? That's probably key things.
Thanks, Edwin. Well, I think we don't have any further questions, so I think that brings our session to a close. But I think just some sort of closing remarks. I think hopefully across this discussion, it's been helpful to understand some of the characteristics that having a sale to private equity or investment private equity will have on the business, and how that contrasts quite differently to some of the other exit options. And I think a couple of the key points that across all of those is preparation, but particularly here, when you're looking at a private equity funder, it's not just about the money. It's really about finding the right party that suits the business, suits the culture, and can support the business in the next stage of its journey. So that's a key message to get across, I think, from today. Don't just look for someone who can fund it. Make sure it's the right fit, and that you're well prepared. So finally, I'd like to say thank you to all our guest speakers, and in particular Edwin for being our sort of special guest from BGF. Thanks all. And thank you everyone who's listened to this one and all our previous webinars. Please